Amazing. We should be live. Happy Tuesday, everyone. It's 6:30 p.m. here in Singapore, 12:30 Europe time, 6:30 a.m. Eastern Standard. Welcome to our KDeFi Twitter space. We're doing them on a weekly basis every Tuesday, and we have a bit of a banter around the markets, crypto, talking a bit about what could happen. Many times we're wrong, many times we're right. At the end, it's all about not so much about the forecast itself or the statements itself, but more about the process, how we get there. And I hope our thinking, logic is giving you great value, whether the actual outcome of that forecast or those ideas actually come into play are always of secondary nature, in my opinion, because many times the forecasting is more important than the actual forecast itself. We also talk about our company, KDeFi, talk about what's happening there. Today, we have done this a lot in the past where we spoke a lot about the company. Today, we're going to talk a bit more about the markets. Obviously, last week, we had CPI numbers come out. We have next week Fed meeting. We have recession fears. We have fears around further collapses of companies, of other crypto companies, obviously minor selling pressure. But then on the other hand, we have a lot of positivity when it comes to technical analysis, blockchain analysis, a lot of people becoming a bit more hopeful about the markets. Obviously, we've seen euro US dollar parity. The dollar has been extremely strong over the last 7 to 8 months, so we can discuss that a bit. Inflation hot, what could be happening till the end of the year? Housing markets kind of scaring everyone a bit. And so earnings season right now, obviously ongoing. All this together creates a very difficult mix, how to navigate the markets at the moment, and what to do as an investor. And so in today's show, we try to kind of dive in a bit, give you a bit of our thought process around this, and then just see where it takes us. Myself, I'm the CEO and co-founder of KDeFi, and as always, we have our head of community, Fabio, with us. Fabio, how you doing? How's everything going on?
Hey, Julian. Hey, everybody. Doing good. Crazy times. We kind of see a little bit of a pump. Like it feels like the last time we had that is ages ago, because since November we had a little bit of a pump in end of Q1 in March, but since then it's dark and stormy out there. So I'm kind of happy that we are pumping a little bit, but I don't know. I saw you made a video on your YouTube channel that you're actually are being a little bit risk on. Do you feel this rally has legs, or is it just a relief rally? And if so, do you have any targets in mind?
I mean, on the YouTube channel, I talked about that. I took the first of many steps on rebalancing a bit of my personal portfolio. Obviously, my personal portfolio is I need to kind of manage a lot of things in my personal kind of portfolio. Obviously, I need to kind of counteract a lot what's happening in our company. Our company is obviously 100% exposed to crypto. There's very little revenue or very little of the exposure that comes from non-crypto. So I always kind of have to keep that a bit in mind when it comes to my personal portfolio. The company is my personal biggest net asset. However, it's not liquid. So I need to keep these things a bit in mind. Obviously, then I need to keep in mind parents, rest of the family, my wife. So a lot of things that I just always need to keep in mind. And last October, I sold pretty much all of my Bitcoin position. Reasoning was very simple. Our company's treasury, the majority that it has in crypto. Again, the majority of the treasury is actually in dollars. But that part that is in crypto, the largest part of that is in Bitcoin. And so I wanted to counterbalance that in my personal portfolio. And I sold pretty much most of the Bitcoin that I use for investing. I keep the Bitcoins that I treat as an insurance. So that's pure insurance for me if the entire world goes to shit, that I have those Bitcoins. But the investment, the numbers going up part, I sold that part. And so I was heavily exposed into US dollars. I did sell some stocks last year. And so I was heavily exposed into the US dollars. And that was during a time when everyone said and thought the US dollar is going to collapse. It's going to completely disappear. And to me, it looked very, very different at that point in time. with what the Fed was doing and the cycle we were in, and that's also why I was always relatively cautious. Yesterday I made that video that over the weekend in my personal portfolio, and we're gonna make an announcement on the company as well. Company still needs to go through a board decision, but since that's u-zyn and myself, it's gonna be a done deal. But we need to go through the official process before we make such an announcement. The company is also gonna take a bit of a more risk on step with its treasury, and I also started allocating a bit of my US dollars into more risk on assets. For me, this was crypto. Today, there's going to be another video where I talk about the allocation a bit. Personally, I'm allocating mostly into Ethereum and into DeFi chain, into a few other hype coins that could just pump. Without going into too much details there, I bought some more stocks. And the third part I bought was some bonds. Very specific reasoning. That's just a bit of a hedge against what could happen in the rest of the market. So yeah, that has been the step that I did yesterday. But what was key to understand in this is that it's not that I went now and went like all in. This was just like a first of potentially many steps of a rebalancing. I mean, I mentioned this a lot. I come out of this school of Warren Buffett, which is never jump into a lake with 2 feet straight, but basically dip your toe into the water and then go step by step. And for me, it's exactly the same. So I couldn't care less right now if the market goes up, goes down. For me, I'm just so overexposed into the US dollar at the moment in my personal portfolio that I don't feel comfortable with that. And so I need to rebalance. I need to sell US dollars and I need to buy other assets with that. So yeah, and we can discuss a bit on why I kind of see it as a good time at the moment. And we can discuss this, but I just want to kind of put some flavor to that. So this is not that I think now the market's going to rally. I don't think the market's going to find a bottom. It's more on everything that I see. I'm feeling uncomfortable having such a strong position in US dollars. And people can do that math themselves. US dollar has pretty much outperformed any other asset over the last 8 months. The exception is commodities. And yeah, I'm not a person that has all too many commodities in my portfolio just because it's generally a very expensive position, a very inefficient position. Commodities generally perform really bad. It's really only those short amounts of times when commodities perform really well, and then they perform outstandingly well. And then if you look at bonds, crypto, stocks, precious metals, I don't own much real estate, but if you kind of look at that, everything kind of collapsed over the last 8 months. So the US dollar position just is absolutely bonkers strong. And yeah, at some point I need to sell that dollar position and I need to diversify into other assets. Maybe flipping that kind of question bit back, Fabio. What do you see right now? I don't know. Do you see that I'm more of an exception in this, or do you think actually a few people right now are like maybe seeing a little bit of a trend change or a kind of momentum change or a sentiment change, or do people not see this so much at the moment? And I want to highlight, I have no idea about what prices are doing over the next couple of weeks. I don't generally invest into a price. I always invest into value. And for me, that there's a momentum change in value. Whether the market agrees with me right now or whether it's going to take a little bit, I don't know. I am not good at forecasting those short time periods. For me, this is really a bit more of a long-term kind of idea.
Yeah, let me tie maybe a few broader things together. So let me start with so Benjamin Cohen. He's one of the biggest crypto influencers, a little bit of a data scientist. He made a poll and he asked, "Is the U.S. currently in a recession?" And I couldn't believe the results because 90% of the people answered with yes, the U.S. is in a recession. So the GDP data will be released next week. And if we have 2 consecutive quarters with negative GDP growth, we are in a technical recession. Currently, the forecasts are saying almost 2% of negative GDP growth, which would put us in a technical recession. So, but there is some conflicting information. So, of course, we have all these indicators like RSI and Mayer multiples, 200-week moving average, which they practically scream buy me now. all these indicators are drastically oversold, and historically speaking, it is a great time to go in. And like when you go back maybe 2 or 3 months, Julian and me, we were always talking about a relief rally, like after the summer and into the midterms. And when this relief rally is going to come, or if we already bottomed, it's almost impossible to know. The issue that, and I really hope we can get into this a little bit later in this Twitter space, because the question that I ask myself, and that I really have some conflicting information, and you're definitely a little bit of a contrarian when it comes to these things. So right now I'm super risk averse. So I actually hold a lot of commodities, and I hold a big cash position just because I have no clue where the market is going. And the main question that comes up and that I read a lot about is inflation versus deflation. Because like if you go on crypto Twitter, everybody's talking about inflation. So we have 9% inflation pretty much all around the world. Or more, even more in other countries, so that everybody thinks, okay, this is crazy. We're going to see inflation. People are talking about hyperinflation, but there are some contrarian views. I know you have a little bit of a contrarian view. I listened to Raul Paul yesterday on Bitcoin Archive. He was participating in a Twitter Spaces. If you haven't listened to this, it's a great space. Archie, the owner of the account, really questioned Raul Paul in a very confronting but friendly manner, and Raul Paul did great with explaining his viewpoints, and it was a great space. But a lot of people are actually talking about that we could see massive deflation at the end of the year. Like there is some theories, the bullwhip effect, which is connected to supply chain issues, that practically everybody sits on a large storage, all these retailers, and they can't get rid of it. And to decrease large storage, you practically need to drop prices. And this is like a sort of a back and forth. So my issue that I have with the current market, and that I just don't have enough experience in dealing with, is, are we actually going into prolonged inflation, or are we actually going to go into a deflation? And there is, of course, if you're wrong with this assessment, if you're speculating, for example, on prolonged inflation over multiple years, and you allocate accordingly, and we actually see deflation, you're probably not going to do so well, and the other way around. So for me, this is probably the question that bothers me the most, or that I try to answer myself, in which direction are we going? And I'm really split 50-50. Like on a sentiment perspective, probably a large majority, like 70 to 80% of crypto Twitter or Bitcoin Twitter, they think inflation is happening. And they kind of feel themselves confirmed with all the data that is coming in. But I know for a fact that you're very good in taking contrarian viewpoints and actually making good calls. So I'm really interested in what you have to say about inflation and deflation, and how this all could play out.
I mean, I love that that discussion. Again, I think the forecast itself is irrelevant, whether it's inflation or deflation. I think what really matters is the thought process, how we get there. So let's start from first principle thinking. Let's not assume any kind of prior knowledge. Let's just go from a very basic kind of fundamental idea. When you talk about inflation, it depends on what kind of inflation we're talking about. If we're talking about that goods themselves become more expensive because there's two factors, actually, because there's either more money that gets printed, or that's the other key part that most people tend to forget, that there's more money in circulation. If those two things happen, or one more than another, then generally, if the amount of goods that is in circulation is not increasing, then the prices of these things go up. This makes a lot of sense, because let's say everyone just gets $1,000, then everyone says, hey, I can spend $1,000 more. And that simply means that milk and bread and fuel and so on goes up in price. If, however, and this is an interesting thing that I always want to kind of bring up when people always, and sadly, always sadly, the crypto Twitter space and crypto in general, and a lot of crypto influencers, sadly, they just copy paste data and graphs without thinking. And one of those graph that's extremely deceiving is the M2 graph. I mean, the M1 graph is even worse. So that's the money supply for M1. The reason why this is even worse because the kind of metric there got adjusted. And so, I don't know, for some weird reason, people share that graph and say 80% of all dollars ever printed were printed in the last 2 years, and that's incorrect. It was just because certain deposits in the US were also now included in M1, and that completely changed that number. But so let's talk about M2, and M2 is is an amount of money that is in circulation in the US, and that number has continuously been going up until the end of 2021. And so people all said, look at this. This number's going up, so that means we're having inflation. The thing is, if I would, let's say, just as an example, I would print $100 billion right now, and I would give all those $100 billion that would show up on M2, obviously, and I would give them all to Elon Musk. Do you think a single gallon of fuel, a single loaf of bread, a single pig, a single piece of butter would become more expensive? Or do you think your rent would become more expensive because Elon gets $100 billion? Of course not. Because very likely Elon would just invest it into his own companies, or Elon would just put it on an account and just wait, because he's not going to go out there, and that's the key part, and start putting these dollars into circulation. So you have to be very careful when you simply kind of try to predict inflation or deflation simply based on money supply. Because obviously this inflation can also simply hit assets. And that's what we have seen actually in 2020 and 2021. The circulation of money in 2020 and 2021 actually dipped down. It went down because people all got these stimulus checks and people got insane amounts of money, but they couldn't spend it. They were all stuck at home. So the few little things that they could spend it on was like social media, was like online stuff, was like internet stuff, but they couldn't really buy those big ticket items. They couldn't buy a new car. They couldn't go out and travel. They couldn't like renovate their house because the workers weren't there. Like it was not allowed. They couldn't get out and so on. So what that meant is everyone had this money suddenly. M2 shot through the roof and everyone was saying, where's all the inflation? Where's all the inflation? Why is there no inflation happening? The inflation happened in the assets themselves. And that's what we saw. We saw this massive excess liquidity. And that's why risk on assets, tech especially, crypto especially, went through the moon because people didn't know where to put their money. And now, after the Fed went last year and said, you know what, we're going to tighten the monetary supply. Plus, and there was a second effect that we spoke so much about and that people really discount right now. For the first time in the last, whatever, let's say 9 months, maybe 12 months, people can actually travel freely again. I mean, Singapore opened up last September. That's when Singapore started to open up. It's completely open now, I think, since January. So the first time that we in Singapore could travel freely is January. Now, I understand that some countries, for you guys, is completely different. You either didn't have any kind of restrictions or no lockdowns, or for some of you, depending on where you are, you're still completely in lockdown. But the majority of countries really started to open up this year. So what happened? Well, people saw that the Fed was tightening. And then on top of it, they said, you know what? Let's spend all that money. And now people are looking for different apartments. They want to move. They spend money on rent. They started to travel. Travel tickets are through the roof. All these things are completely through the roof. So even though, and that's now the interesting part, money supply hasn't changed the entire year. It's actually completely flat. It's 0% chance for the first time in a long time. Inflation is extremely up. And the reason is not because of the money supply, it's because of the velocity, it's the speed of money. It's people actually spending it, actually selling their assets, and actually going and putting it into lifestyle credits. And so if you understand that part now, you need to kind of start predicting people's behavior when it comes to, are people actually going to hoard their dollars? Or are they actually going to spend their dollars? And if people start hoarding again, right, then basically we're going to have a bit of a supply shock of dollars. We see a bit of a deflationary shock. And if people are actually going to spend it, we see more of an inflation. It's always the kind of same idea behind this. So I sit here now and I look at all the expectations that people have. And all the people's expectations are, we are in a recession. 90% of people on Twitter think so. A majority of people actually think so. And whether the outcome actually happens or whether it's just the expectation doesn't really matter as long as the expectation was there. If I would promise you 100% that Bitcoin was going to be at 30,000 tomorrow. And we would all know that there's a time traveler coming back that Bitcoin tomorrow was going to be at 30,000. Guess what would happen today? The Bitcoin price would shoot very closely to the 30,000 today, even though it's only there, it's supposed to be there tomorrow. So it's the same with the recession. It's the same with inflation. I think at the moment, the entire trend from everyone is so skewed towards we are in a recession. We are going to have inflation. This inflation is going to be double digits. The Fed is going to start printing money again. Like all of this is so ingrained in people right now. And what they don't see is the exact opposite side, that they are so far to that inflation side, something that no one was imagining in a year ago. If you were to poll people last year, are we going to see inflation? Everyone would be like, we're not going to see inflation for the simple reason because money's printing has gone down, it has slowed down. So why should there be inflation? What they forgot was that people would spend that money, that people would actually go out, that the Fed was kind of stimulating this entire process, and it just had a bit of a delay. It took some time. And so now I'm sitting here and I'm like, man, oil fell below the price it had prior to the Ukraine conflict. A lot of the supply chains, they were completely clogged up. These supply chains are easing up. Transport costs, transfer costs from Shanghai to LA, there's a lot of these metrics. They're completely easing down. You look at like airplane fares for the rather like Q4 of this year, these fares are completely back to normal. Yeah, Q3 is completely bonkers still, but it's easing up. If you look for flights between Singapore and Frankfurt, which is like, or Singapore, London, which is like there's one of the most flown kind of routes, right? Singapore Airlines, Lufthansa, British Airways. You can do the same for JFK to Frankfurt. You can do LA to Frankfurt. All these routes that are super popular. Singapore, Hong Kong is not working at all right now because Hong Kong is still in lockdown. Right? But if you look at these super frequented routes, they're almost unbookable at the moment. And then you go 3 months in advance, suddenly they're easing up. 6 months in advance, they're like completely normal. Now you can say, well, this is normal when in 6 months, people like they don't book that far in advance. You're right. But also don't forget, a lot of people have been spending a lot of money right now. They are feeling a bit tight. They feel like they don't have that much excess kind of liquidity. A lot of crypto people 6 months ago, they were like, oh, where's my new car? Oh, let me upgrade my new house. Let me go on a business class flight instead of an economy class flight. Well, put yourself into those people's shoes. How do you feel right now? How much liquidity do you have right now? Do you feel like upgrading your car right now? Or you're like, yeah, you know what? Let me rather keep those Bitcoins or DeFi chain, or let me keep those ETH right now and wait for a bit better times. Well, guess what's going to happen? A lot of people are going to travel this summer. And the forecast for travel is such a strong indicator, is actually very, very bleak for the rest of the year. People do not intend to travel much until maybe Christmas again. So they're like, I'm taking this summer because who knows what's going to happen to COVID. Maybe we're going to see the same thing as last year. And in September, we're back in COVID and we're going to see 2 months of lockdowns. So F that. I'm going to go on my trip right now. And then I'm just going to stay at home. Think about yourself. Like you can just reflect on yourself. Reflect the same with like these big ticket purchases, a car, like any new larger sports infrastructure that you're buying, any kind of travel, obviously, anything like renovating the house, all these things. Yeah, you may have wanted to renovate your house, but maybe right now you're like, hey, you know what? Well, I'm not moving right now. Let's wait a bit. And we see this not only in this Twitter space, and I mean, you can just tweet at us and let us know if you feel completely different. If you're like, no, like I'm upgrading everything right now. I mean, this is the best time to sell assets and buy lifestyle credits. Like I'm all in this. If that's you right now, then great. You're probably the exception. I tell you, I think the majority of people I know that I talk to, and it doesn't matter if these are crypto people or if these are stock investors or if these just the average person. You know how many like executives, really like well-educated professionals in large companies I know who are all sitting there and they're like, yeah, you know what? Let me build a bit of my nest egg right now because my company has announced that they stopped hiring, that they may actually let people go because they need to kind of go a bit into a safer time. And let me just kind of hoard cash a bit for now. And not spend that right now. You know what? Like that trip that I was supposed to do, let me not do that. Let me save those $4,000 and you know, I'll just keep them. I can always do this a bit later. And that is gonna cause extremely quickly, and that's what people think that this inflation number is gonna be 9.1, and then it's gonna be I don't know, 9.3, and then it's going to be 9.5, and it's going to go down to 9.1, it's going to go to 8.7. What people just forget is that this is always a 12 months backward looking number that compares a basket of things. How expensive were they 12 months ago? And how expensive are they now? Well, tell me, oil, end of last year, hot, extremely up. A lot of the infrastructure, a lot of the goods that people want to buy, supply chain issues, all of this completely clogged up. The only thing that may not go down as quick, in my opinion, is rent. And that obviously is a significant part in that CPI number, but that's probably the only one that doesn't go down as fast because rent doesn't change as much in general. All the other numbers very likely are actually going to go down simply because they were so sky high due to these supply shocks. And so even though the amount of money is not decreasing or it's not increasing, but the way people are going to spend that money, the speed of money is going to completely move out of the system, in my opinion. And then we're going to see a lot of refilling of those supply chains. And obviously, it's very difficult to predict when this is going to happen, how fast this is going to happen. But I make this prediction that I rather think we're going to see deflation by the end of the year. So that means we're going to jump from 9.1 right now to negative something, because I just think there's a very high chance that comparing this year's November prices, this year's December prices, are actually going to be lower than last year's. And maybe it's not going to happen in November, December, but then it's easily going to happen in March, when this year we had the entire COVID conflict. Oil was all the way through the roof. I just don't see how next year we're going to have a similar scenario. And I really think that people completely miscalculate that simply because they're also focused on inflation right now. They think that all that matters are are interest rates from the Fed, and that's true. Interest rates are super, super important. But in this case, I do believe that that a lot of the inflation was, sure, a lot of it came from the money supply, and all the nations, in my opinion, had a bit of a too long kind of rescue approach with COVID. The first couple of months, I think that was absolutely fine. But then the entire 2021 year, in my opinion, that was just completely delaying the actual recovery. Switzerland, in my opinion, did it really well. Not perfect, but really well. One of the few countries. Most other countries, way too slow in that recovery. And that's what we're feeling right now. So sure, there was a little bit of an oversupply in money. But the major thing on that inflation part was actually not being able to deliver the goods. And so now we're shooting in this exact opposite direction. We're shooting in this direction where people are going to rather hoard cash at the moment. Supply is going to go actually through the roof, and we're suddenly going to have this deflationary scenario. And so if that is going to happen, it's going to be very interesting to understand what could actually happen to the various assets. And here I want to make an important point. This is not the typical deflation in a sense where money becomes scarce and goods are through the roof. Goods just go back to a regular level. People are just completely insecure. It's kind of the opposite that we're seeing with this current inflation. This current inflation is not because everyone has so much money. Actually, people have less purchase power than ever before. Otherwise, just ask people. I mean, they feel like they don't have any kind of purchase power. It's more that the goods were just not purchasable. And now people sit there and they're like, man, now, I mean, sure, I understand now that the used car, the bike, the new car, all these things, yeah, I could buy them now. But honestly, I mean, now I don't want to because prices are down and so on. And I think that's just going to change around. And so that is why I believe we're going to see rather deflation by the end of the year rather than inflation. And it's going to be a very difficult deflationary scenario. I don't think it's going to be this typical deflationary scenario where for example, the US dollar is going to perform well. I don't think so. Fabio and I had this discussion offline where I said I actually think we're seeing close to an all-time high, but close to a peak in the US dollar. I think from here, the dollar is going to trend downwards. And again, why do I believe so? Despite there being deflation, I understand. It's simply because it's not that the US dollar is getting stronger. It's that people just don't know what else to do with their money. And they get so insecure. They don't know. They're just waiting. They're hoarding. And then what, in my opinion, the very likely weird scenario is going to be, and that's just the strange scenario. Everything is priced in. Ukraine, fingers crossed. Let's hope the war either eases or at least doesn't get worse. Hopefully it gets better. Taiwan conflict. Let's hope it doesn't get worse. Or I mean, it doesn't get worse, right? I mean, if the Taiwan situation stays as it is, It's fine. I mean, it's just some tension, but that's it. Then okay, what else? I mean, CPI, sure, of course, maybe we see a 10% CPI number. I don't know if that shocks anyone. I don't think so. And then suddenly, bam, this thing snaps the other way. Fed interest rates. I mean, the Fed reinforced this week again that they said, hey, 0.75 in July. We're not going to do a percent. 0.75. That's what they reinforced. They are talking about 0.75 in September right now, right? So none of that is kind of the big shocker. So always remember, if the large amount of people actually expect everything already, the slightest change to the opposite of that expectation can have dramatic effects. And that is why from everything that I see right now, I'm sitting here and I'm like, what am I not pricing in? Okay, I may not be pricing in that earnings are horrible right now in the next 2 weeks, and maybe this is going to have some short-term effect. I don't think a big long-term effect because everyone is kind of expecting abysmal earning numbers. Sure. Maybe I'm not pricing in that the miners are collapsing and the miners need to sell. Sure. But that historically has been a very good bottom signal because miners generally are the last ones selling. And then there's just no one left to sell. Generally, miners wait until they have to sell. They're generally the last ones. Simply they have to because they need to keep the operations running. Okay, sure, we may see some liquidations from Celsius and Three Arrows and Mount Gox in August. Sure, but then, and so again, I'm not saying I can predict the bottom. This is not the goal of good investor. Good investor just wants to pick cheap prices and sell them expensive. And I believe, that's personal belief, with all these things I see right now, this is where we're standing. I don't know if we see Bitcoin at 15,000. I don't know. Maybe we do. And I couldn't care less. That's fine. In those steps that I'm going to be buying crypto, I'm super happy if I can now buy them a bit cheaper. Just from a fundamental standpoint, the only big, and this is now the only big kind of cloud in the back, is housing, is real estate all around the world. If that thing starts tumbling down, and this is a very difficult one, then a lot of people are going to be very scared. And this deflationary shock is going to get so worse that it's really a deflationary shock where really dollars are king and all their assets are going to get completely slaughtered. And so that's just where I'm standing. And I know this was a super long monologue. I just wanted to explain my contrarian view without just saying, oh, I think we're going to see deflation. I want to explain why I think so. And then you could say, look, Julian, I disagree with you on this thought process. And that's why I don't think we see deflation. And that's fine. You're absolutely correct with that. I just wanted to explain that a bit. And that's where a lot of my contrarian views come from. My contrarian views come from not copying opinions of other people, but understanding from first principles how do cause and effect actually occur in this world. And then try to listen to some smart people. And there's a lot of smart people out there who actually sit down, take that time to explain to you how they, in their eyes, see the cause and effect shaping up. Not giving you the end result, right? Not giving you a model what Bitcoin is going to do. That's ridiculous. No one can predict the price. But actually go and say, okay, these are the kind of models, and this is why, these are the kind of cause and effect connections. And I just think that these causes over the next couple of months are going to cause these effects. And that's all I'm trying to do. It's not easy. I'm not always right, but that's all I wanted to share here.
So Julian, maybe to double down, and to maybe go into the juicy details or challenge a few points that you made. Would you agree that the general preference for institutions and also for retail for the medium-term future is safety and liquidity?
100%.
And so
the question, though, so let me ask the question, right? The question is not so much for the future. The question is, what are the changes of that? And the price of something is always supply and demand. So the question is, if we have a stasis, so if we have a similar supply and a similar demand, then price doesn't change. So the question is more, do we believe that we have people more looking for safety right now? Or have we seen that now we have seen that most people actually have gone into safety? And now they're like, oh my goodness, like I want dollars because like I should have like dollars are the thing to own right now. And at some point, it doesn't matter if everyone wants that. There's just no one left to actually join that corner, right? So that is super important to understand in actually kind of predicting value and where value moves.
And would you agree that in a scenario where safety and liquidity is a preference that so let's just say we made a poll I think a week or 2 weeks ago where we asked our customers where do you actually allocate in? So are you in real estate? Are you in stocks and equities? Are you in bonds? And only about 1.5% of our whole customer base prefers bonds. But when we have a scenario that the whole market is actually preferring liquidity and safety, wouldn't US Treasuries, 10 years, 30 years US Treasury be the place to go?
I actually think so. I think the most exciting investment of 2022 could be treasuries. The super difficult part about that one is that you are actually trying to time treasuries that are, in my opinion, on a very downward spiral. If you're asking me, treasuries over the next 10 to 20 years, an absolute idiotic investment. So you're trying to you know the tide is going down, and so you're trying to time the waves at the moment, and that is why I actually believe this is a very interesting wave. And I bought treasuries. I just would not dare to over allocate for that simple reason, because I do think they're fundamentally not a smart investment anymore. That is why. But fundamentally, from everything that you say, you're 100% correct.
So let me maybe ask you about a few other assets that you. So right now, I'm kind of I'm learning as we are going, and I think a lot of people here in Twitter space as well. We are all fairly young. We haven't been there for a lot of market cycles. So what about we have the chances that this is going to end up in deflation, but maybe a few other people they say this is going to end up in inflation. So me as an investor that doesn't really know what I want to do, how would gold perform in both of these cases?
Um, in gold, actually, in both in a deflation and in a normal inflation, doesn't perform well. Gold generally performs really, really well when there's a hyperinflationary panic scenario, or when there's panic in general, but it's not panic where you see these dollar shocks, but where there's enough dollars, but people just don't know where to run anymore. So when you have these kind of also war scenarios, right? So if Taiwan would kind of really escalate, if Ukraine would escalate, you could assume that gold would go up because it's not a dollar shock. But in regular inflation, let's say the target rate for the Fed, 2 to 3%. Gold is not an exciting investment. In deflation, gold has historically been a disastrous investment, because during deflationary times, you need anything that generates yield. You need yield, because otherwise you're really going to struggle. The big caveat I want to make here, though, is and I mean inflation. I'm not sure gold would perform well over the next months or years in regular inflation, right? I'm not sure. In a deflationary scenario that we would see right now, I'm not sure if gold would perform so bad. And that's actually also a bit of my case for crypto. Because it's not that there are not enough dollars. There are plenty of dollars. People just are scared in spending them right now. They're scared to allocate them to something. And so if suddenly their dollars are worth more as they are right now, their purchase power suddenly goes up again because suddenly prices out there drop. But it's not because money changes, but it's because suddenly the prices out there drop. Their purchase power actually goes up again. And then they could feel more risk on again, which in my opinion would be a case for crypto, and could also be a bit of a case for gold, because then people are like, okay, this may be a good time to allocate to gold. I don't buy gold at the moment. I didn't buy precious metals, simply because I'm way more of a Buffett disciple there, where I always believe I only buy things that I never have to sell, that I can use, or that generate something that then I can use. And Yeah, and so when I invest in crypto, so the amount of Bitcoins I have right now, this insurance, this is the insurance that I intend to use, hopefully never, but I'm ready to use it. If the entire world goes to shit, I can use that insurance. I have no plans in ever using that. The amount of gold I own right now, I mentioned is also, it's kind of a similar idea, but I'm not a gold investor unless I'm fairly certain that numbers go up in gold. And I'm just not fairly certain on that. So the cryptos I'm actually buying right now, and sorry that I interrupt you and I stay on a monologue. So the cryptos I'm buying right now are more cryptos where I'm like, okay, either I can get cash flow in those cryptos, or I can actually use those cryptos because those cryptos are L1s and they tend to be usable for other things. And so that is just a bit of more of an approach here, at least for me right now. And then obviously stocks, very straightforward. I'm not buying the tech crazy stocks that are cash flow negative. I'm buying very boring companies that most people don't even care about. And yeah, and then bonds. So that's just what I want. And then the point is, if you want to allocate yourself, I allocate right now. My position hasn't changed over the last 9 months. You need to be diversified. Right now, I'm just not diversified anymore. And that's why I'm trying to re-diversify.
And so one of the main points you made over the last 6 months while we were doing these Twitter spaces is you consistently said, try not to be wrong. And
Correct.
I think nothing changed. So it's still, and that's also, I guess, the reason why you're diversified, because we just don't know. Nobody knows how the future will play out. So, but there is a few things that are really confusing right now. So we have the bigger discussions where deflation versus inflation, but there are other points that are super confusing in the economy right now. For example, we have a very low labor force participation rate. Unemployment is super low, but all the companies out there, they're actually looking for a job. But there is this general disconnect where the companies actually, they offer below market rates. So the people that are not participating in the working force, they're not willing to go into jobs and practically get paid below market rates. And this is a very weird situation. I can't remember that a scenario like this was happening. I don't know if this was comparable maybe to the 70s or to the 30s or so, but there is this weird disconnect. And I think COVID and the whole pandemic kind of accelerated this. And maybe to add to this confusion, like some people would say the period between 2010 and 2020 was one of the greatest bull markets that we ever saw. But this is not true all around the world. So we had a lot of stagnation, or maybe you could even call it a silent recession or a silent depression in a lot of parts of the world. Like if you look at Japan, for example, emerging markets, or Europe, we have a lot of countries and a lot of areas in the world where there wasn't any economic growth in 20 years. So what is happening there, and how can we as a investor navigate through these uncertain times?
Great questions. I don't know if I'm the right person to answer, to be honest. I don't have the experience myself. I share this all the time. I've been investing for the last 14 years. I don't know if I'm a good investor or a bad investor because the entire investment environment made it very easy for me during those 14 years. I think the big difference between myself and many other people during that same time period is just that I'm very well aware of the environment and what this did to investments, that I'm very well aware why stocks and crypto did so insanely well, and also real estate, because these things tend to do well when interest rates are low and when there's this slight regular inflation, right? When these things are there, stocks, real estate, crypto is booming. There's excess liquidity. This works really well. My entire approach at the moment is, and that is why I titled that video, I'm selling dollars. I didn't title that video, I'm buying crypto. I titled that video, I'm selling dollars. And that is exactly what I'm doing. It's not that I have an opinion on crypto or on stocks or on bonds or something. I just have an opinion right now that my portfolio has way too many dollars. So I really want to put this into perspective, because I feel that this is always when I think in purchase power. I don't think in dollars. For me, it's not a, to me, going into dollars is very predictable. I know exactly what's going to happen over the next 10 years, not year by year, but over the next 10 years. the purchase power of these dollars is going to go down dramatically. So I'm very well aware of that. But obviously, in a short time period, dollars can be a fantastic investment. They were outstanding over the last 8 months. One of the few really fantastic investments. And so now these dollars did so well, I need to sell these dollars because the purchase power I have in dollars is just so high in comparison to all the other investments that I have, except for commodities, but my commodity pool is relatively small. So I need to sell those dollars. Well, what do I sell dollars into? Well, I have only a limited amount of options, which is other assets. So I just need to diversify into these other assets, especially assets that didn't perform so well. The reason I'm highlighting this so much is because I so agree with your statement about the difficulty of the economy right now, difficulty of making predictions, the difficulty on where this entire thing goes. It's just so difficult. And that is why I would be very cautious in making strong bets. That's why I'm not making a deflationary bet at the moment. That's why I'm not making a hyperinflationary bet, inflationary bet. I'm trying not to be wrong still. And the way I'm trying not to be wrong is actually getting out of my deflationary bet, which even though I actually think it's the most likely scenario, which means I want to get out of dollars. And the reason I want to get out of dollars is because they perform so well. And if you sit here today with a portfolio and you say, you know what? Actually, I have 5% of my entire net worth in dollars. Should I now double down because I hear in this Twitter space that someone is buying crypto and stocks? Then my honest answer is probably not. If your allocation is 5% to dollars, I would probably keep those dollars and I would say, hey, great, I have a $5% dollar allocation, right? But if let's say you have 80% in dollars right now, well, I'm not sure if that is a very smart move to have 80% of your purchase power in dollars right now and 20% is in the rest. And then maybe you can see this as a good time to maybe, I don't know, take 10% of those dollars and allocate them into other assets with your purchase power. So that is just the approach that I'm trying to kind of get across here. And talking about a lot of the willingness to work, I agree. And a lot of it just comes from companies having done way too well over those last 12 years, way too well. And with companies doing way too well, that means they don't care about who they hire. They don't care about expenses. They just want to keep growing. And now there's a time where companies just kind of have to get back a bit to their reasons. And they're like, hey, you know what? I don't know. Maybe we're 100,000 employees. Do we really need 100,000? Maybe we only need 80,000. Okay, who are the 20% we are going to fire? Well, let's not fire anyone. Let's, I don't know, let's just reduce some of the benefits. Let's just reduce the benefits here. Let's not do this salary increase. Or, you know, like normally we do this annual get together. We're not doing it right now. And then you see automatically who are the people who are leaving. And that's an automatic kind of filter a bit. So I mentioned this 6 months ago, 8 months ago. I think I keep mentioning it. I think this year and next year are going to be way harder years to invest than all the prior years before. I also think that while I actually am bullish for H2 this year, second half of this year, in crypto, stocks, and bonds, I'm actually fairly bearish for next year. And the reason again is I think we just see a bit of a breather right now, not a massive one. Again, I'm not expecting Bitcoin to go to 60,000 now. I'm really not expecting that. I'm just expecting a bit of a breather. I'm expecting a bit of a breather in US dollars. I just expected the dollar rallied so hard. I'm expecting a bit of a breather, and so I always kind of expected it to happen in the summer. It looked from everything, it looked like a good turning point, and so that is just where all this is standing right now.
I find it super interesting that you made the point with US dollar allocation, and it depends a little bit on the size. And I guess this is true for most allocations. So if I just go back to the poll that we made, we had about 30% or so of people that actually selected I'm all in crypto. And just to make a reference here, like a lot of people, myself included, I came into the crypto space through gold. I was a little bit of a gold bug, and then I came into crypto. And within the last 2 or 3, 5 years, I really found my way into more of the macro things, into more of broader investing, index funds, and actually, like, I was always under the impression that why should you ever invest in bonds? Like I was kind of laughing at people who had a classic 60-40 portfolio allocation. But within like the last year or so, I was really a little bit, I started warming up, let's say, for bonds. And I took my first position 2 or 3 weeks ago, a super small position, but I never owned bonds before because I thought, why should I ever own practically a risk free negative yielding product. If we currently have inflation and these bonds they yield 1, 2, 3%. So why should I ever go and venture into those? But as longer as I'm reading up and on this, and especially in times right now where we could go into inflation or into deflation or a recession or even a depression is on the horizon, it doesn't look so crazy to me anymore to have an allocation of a few percentage in bonds, just because they are very likely to keep their purchasing power, and they are super liquid. And as you said, as the preferences of retail investors and institutions shift to a more they want to be safe and they want to be liquid, bonds seems like a logical allocation. But it's super interesting because I this poll that we've made on our social media, and also the talks that I see in our Telegram groups or on socials, I really feel that a lot of people come into the crypto space, and this is practically their first encounters with investing. But a lot of us, we are venturing into other things as well. So do you have any advice in like for absolute newbies, what is a great place to start? And if I want to get exposure to, for example, a 10-year or a 30-year US bond, what should I buy?
Yeah, I'm so bad at these very specific kind of suggestions or like concrete answers, because this is not me, right? I'm someone who always talks about my experience, what I do, and I'm not that person who is like, oh, if you're a newbie, this is what you should be doing. This is not me, right? So the only suggestion I would have is exactly what you said, namely, like, let me get a bit of an allocation into bonds. Let me see how this goes. Not 80%, but let me buy a little bit. And just that little bit allocation is many times enough. The types of bonds, which kind of bonds? I mean, it's an entire study. I don't know. Don't go with exotic bonds. Go with the country. Go with the maturity that is a very common one, and that's the one that I think is the easiest. It's the most straightforward. So that is just what I would be doing there.
So in my case, I'm at the absolute beginning of my ventures into bonds and treasuries, and the things that I've read so far is that the US 10-year and the US 30-year are like considered the triple A's amongst bonds. Like they're the most liquid, they're the safest, they're the highly most accepted, most liquid products out there. So and there's also like I can get either a direct exposure or via an ETF.
Correct. Yeah, you're right there.
No.
I mean, yeah, either or. I mean, and again, I think if you are more of a beginner, I would probably go more via a bond ETF, just because it's so much easier. If you are a bit more professional, you know how to do it, then you actually buy the bonds directly. I do both. I buy bonds directly. I do buy bond ETFs. Again, because if you ask me which one should you do, then a good answer is always both. Yeah, especially for diversification.
Maybe to one last question. So for me personally, and if you're listening in from the beginning, like I had such a high conviction that we are going to enter into an inflationary times. Like I was even under the impression that this might end up in hyperinflation or the US dollar completely going away. What you kind of read a lot on Bitcoin Twitter or on crypto Twitter, that people are really, oh, this is a revolution. This is the end of the traditional financing system, and we're going to inflationary periods, and you need to hold crypto to protect yourself. So this was my impression that I had throughout the last 2 or 3 years, and I guess I wasn't alone in this. And but if while I'm participating in the market and learning how these things work, I'm kind of start shifting a little bit. That like right now I'm considering that this might end up in actual deflation. So, of course, everything we are saying here is not financial advice or anything, but we're just having a conversation about what is going on and what our thoughts on certain topics are. But if you would give like you said, there is a chance that the markets are actually going to end up being deflationary by the end of the year. Would you give this a straight up 50-50 probability, or are you expecting this to give this
60,
a fair
60-40? I think slightly more probability. If you're asking me if we're going to see deflationary numbers over the next 12 months, then I'm actually going to probably 90% probability for that. I just don't know when over the next 12 months. So by this year, I would have said 60%. The key point then is, are central banks all around the world, right? Are they able to maneuver, taking that money out of the system, balancing that with the supply chains, balancing that with uncertainties around in the ecosystem, that they don't need to start printing again? Because that is still the major thing that could just completely flip this thing around, right? And that basically means, yeah, we may see a deflationary trend right now. Then housing comes down, everyone panics, the Fed panics, everything starts crashing, and they're going to lower interest rates completely again, and they start printing again. And then we're going to see exactly the scenario that you say, and that's what a lot of crypto, obviously, fans think that's going to happen. And it is possibly going to happen. I just think that we're not going to see housing come down this year. I think we're going to see it come down rather next year, if it comes down, and let's hope it doesn't. And so that is why I'm a bit more bullish for the rest of the year. I'm a bit more bearish for next year. But then again, I'm not making any concrete bets on these scenarios. I'm actually making the bet where let me hedge everything and let me just try to be correct. And that's why I'm selling dollars.
This is actually a great point, because let's just say I am a DeFi degen, I am a crypto enthusiast, and I'm all in crypto, all in. I have a little bit of dollars on the side, and the rest of my capital is in crypto. How could I hedge myself against my portfolio allocation?
Hedging, I mean, the only free lunch you have is diversification, in my opinion, right? So sure, you can go and you can buy put options, and sure, you can go short things, but I don't know. Most short funds are just not performing. Most options are priced in a sense where you need to actually go into those things when you are the contrarian. At the moment, I don't think you're the contrarian if you're trying to hedge your portfolio, because everyone is kind of expecting stuff to get worse. When I just don't understand what would have to happen for stuff to even get worse. But so to me, the free lunch you have is just diversification. And the diversification has to come from assets that are to some extent uncorrelated. And yes, over the last 8 months, because the dollar just completely destroyed everything, it's like a wrecking ball. Everything was kind of correlated, because that's what happens when the thing most things are denominated in, the dollar is so strong. And that's why everything was correlated. But I just still think that's the free lunch we have. At least that's the free lunch I'm using. If you know something better, I'm always all ears.
I love it. I love it. I really love this discussion, and I think we are going to see a lot more of that, a debate, especially inflation and deflation. And the next few weeks are super interesting, because GDP data will come in. We will see a new Fed meeting, I think in about 10 days or so. The Fed is, you said, the likelihood of them raising by 75 basis points is super high. And they already said they are going to do the same in September. So I think, and then we have the midterms coming up. So we are more than halfway into the year, but there is still so many things that could happen, and a lot of potential for playing out. If you're interested not only in crypto markets, but also in a little bit of the macro landscapes, like things that we are talking about today, make sure to tune in. We are doing this every single week, 12:30 Central European time, 6:30 p.m. Singapore time, every Tuesday. And thank you for all the
No
insights.
financial advice. Quick reminder, right?
No.
We may be completely wrong with our personal investment decisions. All of that is completely detached from our company. I just want to be very clear on this. This is super, super important. It's my personal portfolio, personal thoughts, and I'm trying to put in as much as possible. So whatever you kind of come up with, that's going to help with your own decision making. Yeah. Thank you so much from my side, Fabio. Thanks. Yeah, tune in next week. Fabio, I'll leave you with the last words. Really, thank you so much for doing this together.
I'm going to use this to shamelessly shield the company that I work for. If you're not a customer yet, really, what are you waiting for? There is a $30 sign up bonus waiting for you. Just cakedefi.com, sign up, and make your first deposit of $50 and more. And we are not only a crypto platform. You have the possibility to get exposure through DeFi products in bonds, commodities, real estate, and stock tokens. Have a look, cakedefi.com. Thank you all for tuning in. This Twitter space is going to be recorded. You will find this on YouTube, Spotify, Apple Podcast, or you can listen to the whole episode right here on Twitter. Thank you, everybody, and have a great day. Bye-bye.